following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp, the program where we take you, the basic retail stock trader, and we break you mercilessly of all your old bad habits, things like buy and hold and all that crazy nonsense. And then we rebuild you into seasoned options veterans. My name is Mark Longo from the optionsinsider.com, as well as from a little thing we like to call the old Options Insider Radio Network. And for those of you looking for ever more options content, the network is indeed expanding yet again. In fact, as you're listening to this, our new show is launching. It is Trading Tech Talk. It dives into all the hardcore tech that powers the trade. So when you click your mouse, what happens from then to the clearinghouse and back again, and all the awesome, super high-end technology that goes into making those executions possible. Check it out, Trading Tech Talk. Of course, you can find it on theoptionsinsider.com or on iTunes, Stitcher. Wherever you find this fine program, you're going to find that show as well. And joining me on the old Options Bootcamp drill instructor squad are my usual two compadres, starting off with the man beaming in from the hinterlands of Chicago, a.k.a. scenic, lovely, perhaps even balmy today. It's Frankfort, Illinois. You know him, you love him as the prima donna himself, none other than Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the program, sir.
Oh, I don't know if balmy would be the exact right word I would use for today. I mean, it's close. It's in the same vein. It's definitely weather-related.
Well, it's about minus 10 downtown, so what's it, about 75 degrees down by you then?
It was a solid 0 before any wind chill is factored in here. You must realize we're way down south. For those of you who live in Chicago or are familiar with Chicago, once you're south of I-80, everyone thinks you live in this, like the south, the deep south. So I'm about 3 miles into the deep south of the United States.
That would explain the accent. Yes, we are, of course, recording this in the depth of the polar freeze, the Arctic tundra that is Chicago this year. Apparently, we're making up for all of our good winters from seasons past, all combined into one mega winter. But c'est la vie, that means it's great time to be inside, be in the old studio, and do some options boot camping, if you will. Also joining us on the show, a little less spry because this weather is taking it to him a wee bit hard. He's recovered somewhat from the last show. He's got most of his voice back, but he's still a little bit under the weather. But still, he is game enough to join us on the old program today. He is the options major domo over there at sogotrade.com, Mr. John Critchley. John, welcome back to the program, sir.
Hi, folks. Glad to be back, feeling a little better. Polar vortex in New York City also, but I think by the weekend for the big game on Sunday, I think we'll be okay. So that's good news, and looking forward to the show.
And you do sound light years better than you did last time, sir. So I think you're making improvements by leaps and bounds. All right, and with the team assembled, we're going to dive on into our first segment, our options drills segment.
Call in, Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, welcome to the options drills segment, which is not a segment we get to as often as I would like on the show because we're so busy introducing the basic options concepts and doing a lot of basic training. But we thought what we'd do today is take some of those concepts we've hit on a variety of shows in the past and tell you how to implement them, like the man says, to achieve a specific objective. In this case, it is indeed to become more of an options investor rather than a trader. You know, I joked at the top of the show about buy and hold, but a lot of the people who come to the options market, a lot of people who are coming to this show in particular, coming from the stock world, they're used to establishing a little bit longer term positions in equities. And so when they come to options and they hear us talking a lot about these fast in and out type trades and things like that, it can be a little off-putting to them. It can be a little overwhelming to them. They can really just not be able to wrap their heads around it right away. But it is important to discuss the other side of the options toolbox, and that is indeed the more of the investing side. I know Dan has talked many times on the show in the past about the difference between an options trader and an options investor, and we're gonna get into that a little bit more today. Like we said, a lot of the strategies we talked about on the show involve short options trades, and these are, of course, ways to generate income, things where you want to focus on the nearer term of the options chain. You want to focus on the monthlies, if not the weeklies. And these are very, very short-term trades. You're going to churn them and burn them and keep going on to the next one. But a lot of the investors, like we said, they want to take a longer-term type approach, have a little bit longer time horizon. They want to establish some exposure to an equity or an index or an ETF that they like. And they want to use options to do that. And there's a lot of great ways that you can do that. Now, we'll start off with perhaps the lowest of low-hanging fruit when it comes to options as a quote-unquote investment tool. This is one we kind of denigrated in the past on the show, and I'm probably going to keep going with that thought process today. That is, of course, your basic out-of-the-money call. We've talked about that on the show in the past. If you haven't listened to those episodes, I encourage you to go back, check out the archives, theoptionsinsider.com, or in iTunes or Stitcher. Find our early shows about buying a call, buying options, and we'll walk you through a lot of those things like the Greeks and probability of expiring in the money and all those kind of things. But essentially, the out-of-the-money call is the way a lot of people start off because, quite frankly, it's cheap. They see an underlying they want exposure to, usually a stock, let's say Apple. Look at the at-the-money options and say, wow, these are pretty pricey. Let's look at these out-of-the-money options. Oh, they're a heck of a lot cheaper. I'm going to buy a bunch of those, and I'll use those to establish my underlying exposure, my delta position, my volatility position in those. And if you listen to this show ever in the past, you know, like I said, we're not big fans of doing that because of all the reasons we've outlined before. The probability of those options actually paying off is very low. They are made up of nothing but extrinsic value, a.k.a. they have no meat on those bones. They're just nothing but decay. They're going to decay all the way to zero if everything else holds fast in the marketplace. So that's not perhaps the ideal way that we would recommend. So I think if one of the things we're going to do from this show is maybe walk you away from doing that. And so let's move away from that for a second and instead talk about a strategy we touched on the show before, which is probably a better use case for taking the stock approach with options, the investor approach with options. That is something, indeed, we touched on in much more detail in episode 20 from April of last year. So if you haven't checked it out, I encourage you, again, go to the archives, check out episode 20 to learn more about stock replacement strategy. But in a nutshell, it's a great strategy to use when you want to use options in lieu of using stock. I know, Mr. Passerelli, I'm sure you are a big fan, of course, of the stock replacement strategy. You probably recommend it to a lot of your newer, more inexperienced clients who are coming to you looking to replicate their stock trading ways using options. So why don't you go ahead and give our listeners another basic overview, a refresher, if you will, on the old stock replacement strategy.
Yeah, the stock replacement strategy can be a really, really practical strategy for investors. It's a pretty interesting strategy for when somebody owns a stock as a long-term investment, and lo and behold, the stock moves against you, maybe 25 to 35%. Now, that's kind of criterion one. It's also required that the investor believes the stock is going to retrace about half of what has been lost. So if you're sitting there, you own 100 shares, 500 shares, 1,000 shares, whatever it is of a stock, and the stock has moved against you, and you're looking at it and you go, holy crap, I think this thing's going to keep falling. This is not the strategy for you. But if you're looking at it and you go, oh, yeah, well, okay, I see what happened here. I don't think the stock's going to get back to where it was, but I think it's going to go back, it's going to retrace about half of its loss. Now we're on to something. This could be a perfect strategy for you. Basically, all it is it's adding what we refer to as a 1x2 or a ratio vertical spread as an overlay on top of that stock position. So you would buy in at-the-money call and sell 2 out of the money calls at a strike price that matches up pretty closely to where you think that stock will be in 2 to maybe 6 months. It's very important that the time horizon is a factor in your forecast, because if you think the stock's going to retrace in a week or two, it's not going to work as planned. The reason is because when you have that 2 to 6 month time horizon, you can usually sell those 2 calls for about the same price as the 1 call that you buy, meaning you're adding no additional risk to the trade. No additional risk to the trade. You still own the stock. If the stock moves against you and it continues falling, you're still going to lose on the stock, but you don't lose anything extra on the strategy, on the overlay. So I'm just kind of giving a little bit of an overview right now. I can go on and talk about this for a long, long time. I do want to caution one thing here. It's not a universally useful thing because of, like I said, you need to believe that the stock is going to retrace half of its value. And it doesn't really work so well with options. I literally got an email today from a brand new one-on-one coaching student. And the email said, hey, Dan, listen, I owned a bunch of Apple calls and, now they're worth nothing. Is there a repair strategy I can do? And the answer is, well, not really. Certainly not the repair strategy that we're talking about. Maybe there might be something different to do in that scenario. But that's kind of the overview of the stock repair strategy.
I love having Mr. Pastorelli on the show because he always jumps about 3 steps ahead of me here on the program. But let's dial it back even one notch for those of you who are a little bit confused by that, because let's start off with just basic stock replacement, which is even more basic than what Dan just talked about, which is, of course, you have a stock position, like a lot of you coming to this show do. Stock in Apple, stock in XYZ, whatever the underlying of choice may be. And you say, how am I going to use options to replicate that? Well, there are a number of ways, some more sophisticated, but the most basic, the easiest way is simply to look at that position and say, okay, I have a little bit of a longer term horizon. Let's say 3 to 6 months, I'm going to be bullish, near-term bullish on this underlying. Let's look at the options and see what I can do with that instead. And so what this is called is actually, just like it sounds, a stock replacement strategy. You're going to sell that underlying position, close it out, and instead look at the options chain and say, I have about a 6 month time horizon. I'm going to I like the 6 month out, let's say usually north of 70 delta, so 70, 80, 90, somewhere in that range. Options that are in the money. So obviously they have a little bit of meat on those bones, a little bit of intrinsic value in addition to all the extrinsic value. Now, why would you buy this option in lieu of stock? Well, a variety of reasons. And again, we touched on this before. If you want to go into the full rundown, check out episode 20. But a lot of the benefits, first off, are capital efficiency. Options obviously are leveraged instruments. You could put on the equivalent to the same directional exposure you had on owning the stock for a fraction of the actual outlay of doing it. Now, that will vary depending on how deep the option is that you buy and how much you actually spend on that. But it usually would be substantially less than buying the stock outright, and indeed even buying the stock on margin, which is 50%. So that's the first and probably the primary consideration for a lot of people. And of course, it has all the other ancillary benefits we've talked about before. It has a Greek's position, so it has a delta, which is going to approximate somewhere 100, which is the actual underlying itself, but it's not going to be 100. So if the underlying drops, of course, which is the worst case scenario in any long underlying position, any investment type position, then your option is going to decrease at a slower rate than the underlying would itself. Underlying stock drops $1, your stock has only lost $1 in value. That's it. You have an option with a delta of 75, you only lost 75 cents. And guess what? As the underlying keeps dropping, then that delta is going to get smaller. You're going to lose money at a slower rate. You also have volatility coming in to help offset that a little bit. You're not going to make money on a down market, but you're going to lose money at a slower rate. And that is indeed another attractive reason why you may want to consider buying an in-the-money call as opposed to just buying the stock itself. And again, if you want more details on that, check out episode 20. And then if you're in the scenario that Dan just described, where you have a stock position that has, shall we say, turned against you a wee bit, then the scenario he just outlined is ideal for that, which is, of course, the stock repair, which is just taking the basic stock position and adding essentially a ratio vertical spread. And if you want to learn more about those, of course, check out our archives as well, where we get into basic spreads on this program. But again, that's just a way to put on a position, like he says, with zero or minimal additional outlay that will dramatically boost your returns to the upside and not add any additional risk to the downside. Again, an ideal use case for options. Now, we're talking here about being more of an investor with stocks and with options, but there are ways that you can use, indeed, options to augment your existing stock positions as well. We're not complete anti-stock people here on the show. Stock has its purpose. And if you are going to be a buy and hold guy, then you probably should look at some ways to use options to augment those types of positions, usually through income generation type strategies like covered calls and protective puts. So Dan, really quick, why don't you give us an overview of those two? Again, we've hit on those many times in the show in the past, but for the new listeners, people who want a refresher, give us an overview on those kind of two basic income generation strategies against a long equity position.
So the covered call, swear to God, just before we got on this call, I was emailing with a student. I actually didn't have time to finish the email about a covered call position she put on in Netflix. Basics of the covered call: you own shares, and then you sell typically an out-of-the-money call to generate some income on those shares that you own. It's thought to be a pretty conservative investment strategy. And if you're an investor, a long-term investor, I can make a really nice addition to your portfolio. As far as active option traders, I don't know. It can be a little bit of a challenge. And what I started typing in this email to my student is, she planned on it being a week trade, like a week long, week is in time horizon, not anti-strength. And so she bought shares of Netflix and then sold a weekly's call against the shares. So my email was, hey, look, why are you buying, Netflix is a very volatile stock. Why are you buying shares on a volatile stock that have, practically unlimited risk? I mean, the stock can fall to zero, and God knows if the stock fell to zero, it's going to feel like unlimited risk to anybody who owns those shares. So, maybe there could have been a different strategy to use instead of buying the shares. And then why are you selling calls and limiting your upside potential? You're basically adding volatility risk to the downside and taking away potential volatility appreciation to the upside. So, again, this is kind of similar to my last rambling comments about choosing the right strategy for the right situation. Here's when I like using a covered call. I'm an investor. I have shares in my portfolio that maybe it's a 401 or maybe it's an IRA or something like that. I don't plan on selling those shares, but I don't think the stock is really going to go anywhere. So what I do is I sell a call that enables me to take in some premium on those options. It gives me a little bit of limited downside protection. So, if I think the stock's really going to tank, I would never sell a covered call. Only if I think it's going to be in a sideways pattern. Because if the stock falls a little bit, I can still make money on a stock that falls just a little bit, which is great. If it falls too much, then I run into trouble. Now, what if the stock rallies? Well, if the stock rallies, I make money, but if it rallies hard, I don't make as much as I would if I didn't sell the call. So if I'm really super bullish on the stock, I think it's really going to take off, I would never do a covered call either. Just looking for a nice little range-bound stock when I think it's pretty boring. So there's the covered call. Reasonably simple and straightforward. Again, we can talk a lot more about it, but that's the gist of it. The other one is the short put. Now, the short put, for those of you who are listening to the show, but you're not really a boot camper, you're actually an options pro in disguise. you know that the short put is basically the same thing as a covered call. As far as a put-call parity synthetic relationship goes, it functions in profits and losses exactly like a covered call. But I digress a little bit there. Let's kind of start with the basics. If I sell a put, the difference between selling a put and doing a covered call is typically the put is out of the money, so it's a lower strike than where the stock is trading, whereas with the covered call, it's typically a higher strike than where the stock is trading. So if I sell a put, here's what my motivation would be. If I'm an investor and I'm looking at a range-bound stock, and I don't own it yet, but I would own it if the stock fell a little bit, I might consider selling a put. So again, I'm still looking at this range-bound scenario. I'm looking at a chart and I'm thinking, hey, this stock's not really going to do anything for the next month or so. I don't own it yet, but I'd be willing to own it if the stock fell. Now I might think about selling a put if I'm an investor, not an active trader. The way it works is I sell this out of the money put. If the stock stays where it is, or rallies or falls just a little bit, but not down below that strike price that I sold, I make money. Now, if the stock really takes off to the upside, I only make a little bit of money, because when you sell options, the most you can make is the premium you collect when you make the trade. So again, I'm not looking for a high flyer. I would never, ever, ever sell a put on something like Netflix or something like that, because I'd limit my profit potential. It'd be kind of silly. And to the downside, if the stock falls below the strike price and is trading below the strike price at expiration, I would get assigned on the put and therefore buy the stock at the strike price. And I kind of P&L what I collect for the put, to give me a lower effective purchase price on that stock. Bottom line is, again, just sort of giving everyone the gist. If the stock falls below the strike price, I'm going to own the stock. So if I think the stock's really going to tank, I would never sell a put either, because I'm buying the stock at a fixed price. If I sell the 50 puts and the stock falls to 20, I'm buying the stock at 50, $30 above where the stock's trading. So, again, that's why I say selling a put is for a nice little boring range-bound stock where if it dips a little bit, I'd be happy to buy it. Now, what's this for again? It's for longer-term investors. If I'm an active trader, I just plan on having this trade on for a week or so, I would never just sell a put. I would always sell it as part of a put spread because it has limited risk. I make less money with the put spread. Yep. So what do? I sell 2 put spreads instead of 1 put. Then I make about the same amount of money and I have limited risk. All right. So that's the gist of it. Those are 2 strategies that are pretty similar for investors for range-bound stocks. 1, if you already own the shares, and 1, if you don't own the shares yet.
Yeah, that was just really fantastic stuff by Dan. 2 really quick points that I'd like to add. About the, selling the naked puts. We know the mainstream media, if you watch some of these shows and so on, they will extol the virtues of selling the downside puts, saying, well, if you sell the 100 put at $3 or $4, you're gonna own the stock at 97. You might not mind owning it there. Just be careful. You have gap risk. The stock opens, like Dan was saying, Netflix, and it opens down, 10%. You're going to own this. You're going to own the stock at a much higher price than if you just had a buy limit order. That's the first thing. The second thing is, the covered calls that Dan mentioned. They're a wonderful strategy for the retail traders. Using the first strategy that all customers, they take. It's buy 100 shares, sell it out of money call, generate income. That's great. And the primary reason, this I don't think we've mentioned this before. The primary reason why these covered call strategies are so wonderful and why they outperform over a long period of time, long only strategies, is the fact that there was a study that was done that showed that if you look at the implied volatility priced at the in the money S&P options, the spider options, the implied volatility exceeded the realized volatility 80% of the time over a 10-year time period. What that means is that 80% of the time, the implied volatility, the juice of the options, was greater than what actually happened in the stock. So that's why the covered call strategies, when they've done studies, they've shown that they outperform in the majority of the time certainly in neutral markets, they outperform. In up markets, slightly up markets, they outperform. Down markets, they outperform. The only time they don't outperform was maybe last year when we have it up 30% a year. But in general, they're just great. They're great strategies. And if customers want to use weekly options, I would say that's fine. Just be careful that doing weeklies, you're going to generate more commissions for a company like Sogo Trade, but it might not be the best strategy for you. So look at maybe, if you want to use weekly, that's fine, but look at maybe monthlies or 2 or 3 months out. And if you want to do weeklies, come to Sogo Trade because we do have very low commissions, but just make sure you do your due diligence for what it's going to cost to get in and out of the trade.
Yeah, probably best to cut your teeth on maybe a little bit longer term, like a month or maybe even a month or two out, so you get a handle on it. And then once you start to become a little bit more experienced in writing those covered calls and setting them up, then you could migrate to a little bit more premium harvesting end of the spectrum into the weeklies and see how that works for you. Okay, and the topics Dan hit on, we, of course, have hit on those on the show in the past. If you want more detailed explanations of things like covered calls and short puts and all kinds of other cool income strategies, and check out Options Bootcamp episode 24, which we did back on June 26th of last year, 2013, and the subsequent episode 25, which we did on July 3rd of 2013. That gets into alternative income strategies and also how to use those income strategies in things like retirement accounts, things that will interest a lot of the people listening to this show who are looking at options as investment tools. Now, another great tool you need to have in your options arsenal when you are indeed that longer-term stock investor is the collar. Dan just talked about writing puts and selling covered calls. Now we're going to talk about buying puts and selling covered calls. And this is ideal in this market scenario. As we're recording this right now, it is late January here of 2014. The market has, of course, experienced an extended bull run, and now coming into January of this year, we've seen it get its wings clipped a little bit. It's off about 1% a day the last couple of days, kind of unched a little bit today, a little bit down today, but it's been just some darker days over the past few weeks, and people in general, given the elevated level of valuation in the marketplaces, have been concerned about keeping those gains that they've made in the marketplace. And that's where something like a collar really comes in very handy. I've often called this the holy grail for financial advisors because it's ideal for them to put their clients in. It's very much a very simple strategy for protection and income. And this is also ideal for the basic retail stock trader who wants to use options. And what it involves is, quite simply, you have an equity position, perhaps an index position, whatever it is, you have some gains in, you want to protect them. You come in, you buy usually a slightly out of the money put. You have to really do a little bit of your homework to decide which level in the underlying you want to kind of lock your gains in at. A lot of times people will say, I'm going to write this put at this, I'm going to buy this put at this level so I protect my gains from 3% down and below. Some people will use different factors, whatever their criteria is for how much they want to protect. And then they've locked in that level. Now, of course, that can be expensive. You can just do the put outright, but that can be a very pricey thing, depending on the underlying, depending on the time you buy that, the volatility environment impacting the price of that put. It could be a very expensive road to hoe. So a lot of people like to use options to offset the cost of that protection, and that is indeed where the collar comes in handy. And the collar combines just that basic out-of-the-money protective put with an income generation strategy, in this case, a covered call, which Dan just outlined. Again, we've talked about many times on this show. Now you take those two strategies, long equity position, buying an out-of-the-money put to protect it, and then writing an out-of-the-money call to generate some income and offset the cost of that put. And now what you have essentially is a position where you're protected to the downside for a minimal amount of outlay. And if the underlying does indeed continue to rally, which it might, you get to participate up to the level at which you wrote that call. So you still get some upside to the position as well. And it's a great thing for people who are a little bit longer term, maybe a little bit concerned about near-term downside risk in their portfolio, but don't want to sell it out just yet. Moving on to another strategy that I think is interesting. We haven't really touched on this too much on the show in the past, so it's a good thing to introduce here in this options drill segment. It kind of takes some of the concepts we've touched on before, like covered calls, and like maybe to borrow a phrase from Emerald, it kicks it up a notch. People are always saying, how can I get more income, particularly in this environment. Up until the last week or so, volatility wasn't really present that much in the marketplace, so it was kind of difficult for premium sellers and income generation strategies to really make a decent return. So they're looking for ways to augment it. And the covered call is one way to generate income. Short put's one way to generate income. What if we combined them? Now, Dan, I know I just blew your mind. But what if we combined those two strategies into one? So we're selling a covered call and also selling a naked short put, all against a stock position that we already own. Did I just blow your mind or what?
It's funny, Mark. Two things. One, you made the Emerald reference, and, I can kind of see a little bit of a correlation. Maybe not a total separated at birth, but, maybe you could be like Emerald's first cousin or something.
I am a whiz in the kitchen when I'm not recording options audio.
And the other, probably more relevant part of what I wanted to talk about here, I have indeed heard of the covered strangle before, although I think I heard it under a different name. It was called a covered combo, and I'm not really sure why, but that's how I heard of this strategy for the first time. And the first time I heard about the strategy was, probably almost 10 years ago. And I looked at it, I'm like, this has got to be the dumbest strategy I ever heard.
And I'm glad you said that, because that seems to be everyone's first take when they're first encounter. They're like, what? What is this madness?
Right. However, after looking at it for a long time, it probably took me a month or two to warm up to it. Under the right set of circumstances, I can see an application for it. So here's where I can see it working. Now, I'm going to give you my exact same thing, trader versus investor. If you're a trader, it makes no sense. If you're an investor, it might make sense for you. Here is what you do. If you own shares of a company and you think the stock's going to be in a range, not necessarily a tight range, but a range nonetheless. And if the stock gets down to the bottom of that range, you'd probably scoop up some more shares. But if it gets to the top of that range, you'd sell shares. You'd sell out what you own. You're not afraid to sell that stock. But really what you think is going to happen is that it's just going to stick in a range. It can kind of make sense. It's kind of the best of both worlds of a covered call and selling a put. And I say the best of both worlds because it kind of has a little bit of like a dual sort of secret hidden benefit in that you're getting two option premiums, but you can only run into trouble on one of them. And as far as running into trouble, if you run into trouble on the upside, like the stock rallies too much and your short call becomes in the money, well, hey, you know what? You still make money. In fact, you limit your profit potential, but it's not just like a covered call where, I sold the strike and now I'm above the strike, so I limit my profit potential. The stock can actually rally sometimes significantly above the strike price, and it's still worthwhile doing because not only do you get that premium from the call, but you also get the premium from the put that at this point, is going to expire worthless. Like the put's 100% winner. So rallying too much, it's okay. I mean, sure, if the stock really takes off and doubles, then you just left a lot of money on the table. However, if the stock falls, you kind of have the same thing that you do when you sell when you just outright sell a put, but you kind of have the extra benefit of that call that you sold. All that premium kind of gets P&L'd against the strike price, and your effective purchase price of the stock can be significantly below the strike price. Now, I alluded to that before when I was giving you the gist of selling the put. It probably makes sense just to offer a little bit of a crash course here to explain exactly what I'm talking about. Let's say a stock's trading at $55. I sell the 50 put at $2. Now the stock falls below the 50 strike and it's trading there at expiration. I get assigned on that put. I buy the stock at 50, but I collected $2 on the put. So it's the effective purchase price is 48. It's like I'm actually buying the stock at 48. Okay, so that's just selling the put. If I do this covered strangle, maybe I sell the put at $2 and the call at $2. Now, if the stock falls and moves against me and it's trading below my 50 strike at expiration, well, okay, sure, I buy the stock at 50, but I collect the $2 on the put and $2 on the call, so my effective purchase price is 46. So it's like a covered call and it's like selling a put, but it's better than either because if the stock goes up too much or down too much, I get extra wiggle room. So for a long-term investor who already owns a stock and I don't plan on, selling the stock here, I would sell if it goes higher. I'd buy more if it goes lower. It can be a really, really great strategy. For the more active trader, well, you can probably put on a trade like that in a different way that has less risk, for bigger trader-oriented positions. But for a long-term investor, under the right set of rules, under the right set of circumstances, I actually kind of like it.
It's interesting you mentioned this one because people are always chasing that extra degree of income, and this one has come up with its other, perhaps more dangerous, more scary brother, the covered straddle. And it's one a lot of people have floated out there. I know OIC has done a lot of studies on covered calls and collars, and they thought, what about adding this covered straddle / strangle component to it? And it just blew a lot of the advisors and other people, institutional investors, they were trying to aim that research at. It really blew their minds because they couldn't process the notion of getting long double essentially to the downside. So that's probably the one takeaway from this. The most important part is that you are indeed going to get long more of the underlying, whatever the amount is, whatever the ratio is compared to what you sold to what you own on the puts versus underlying side, you're going to get long more of that. So as long as you're cool with that and as long as you understand what Dan really outlined there and you have your levels in your head that you don't mind buying more of the underlying here, and you probably would do it anyway with a limit stock buy order, then there's no reason not to pursue this strategy. But you have to be careful. And indeed, the nasty older brother to this one is, of course, the covered straddle, and that is where we start to get into some interesting areas. Of course, at-the-money straddles are what we're talking about here, and that's where obviously a lot more premium can be captured by doing that, but it's becomes a little bit more difficult road to hoe to because obviously at-the-money option is going to be more pricey, going to have much more premium to collect, but also a lot more vol going into there, and a lot more for that to perhaps go wrong in the near term. Obviously, you're clipping your upside a bit more because your underlying can only move so far before it's going to get called away, and if you're writing the closer to the at-the-money strike or indeed the in-the-money strikes where you're writing that covered call, the higher your probability of that stock getting called away. Not exactly a bad thing, as we've hit on the show many times in the past. Having your stock called away can be a good thing, particularly if it's staying relatively unched and you just collected all that straddle premium. That could be a great trade, but you need to be cognizant of that. And indeed, to the downside as well, you're going to get long stock a lot faster when you're doing the straddle versus the strangle. So I probably recommend for a lot of the listeners of this show, if you're considering a strategy like this, maybe you start with the strangle. Give yourself some wiggle room. Give yourself a feel for how this strategy performs in a variety of environments. And then if you really start wanting to kick it up a notch and you understand the risks, maybe a covered straddle, and maybe if you're worried about the risks there as well, in addition, maybe you add the iron fly type parts and you buy the wings to protect yourself. Again, check out our Spreads with Wings episode here if you want to learn more about things like iron flies and iron calls. Now, John, all this talk about adding downside short puts to stock positions must really be blowing your mind. I know you're not a big fan of those. But you're also very, very well versed in the margin side of things. So tell our listeners who are listening there saying, hey, this sounds like a great way, a great free lunch that I can put on all this extra income on my existing stock positions. Why don't you walk us through some of the margin requirements they probably have to be familiar with if they're going to put these trades on against existing long equity positions?
Sure. I mean, the covered straddle is and the covered strangle, these are, not necessarily new terms to me, but they're actually Dan brought it up. They're really pretty cool strategies. And, for the cover straddle, if this trade or this strategy, you should probably use if you're going to, if you want to buy 200 shares, so maybe just buy 100 shares and then sell the straddle. And then, you're in a position, you're going to get assigned either the stock taken away from you or you're going to own 200 shares. But, and you are leveraged to the downside, but at least the premium, the double premium, so to speak, offers some cushion. So, but as far as the margin goes, a covered call, the only margin for a covered call would be the long equity requirement, which is 50% of the underlying for a margin account. And if you do any of these trades, the only extra part is, so we'll optimize the trade for you, or other platforms will also, and you're just going to have enough to buy the long equity, and the other part you need to do is you need to have enough money for the short put, which is going to be, 20% of the underlying minus any out of the money amount. So that would be the margin. So you have some extra margin. But again, if you look at it, if buying 200 shares, you would need to have enough money to buy 50% of the underlying. Where if you do a cover straddle, it's going to be 100 shares, 50%, and then 20% of the underlying value. So actually you can get a little more bang for the buck if you really did want to buy 200 shares. So it's actually a pretty cool strategy, and one that I haven't really delved into too much or recommended too much, but Now that we brought it up and we're looking at it, I think it's a pretty cool strategy.
I'm surprised. I thought you'd be clearly on the naysaying side of this. Anything that involves a short put, I know you're not a huge fan of. But yeah, you're right. It is an interesting one, and you can game the system a little bit there with the margin, which is why I wanted to discuss it here, particularly versus just buying stock outright, which we know is just 50%. Not much you can really do with that. And of course, we call these covered. The term covered is kind of a misnomer. You're covered to the upside. You're essentially doubling down to the downside. So maybe you call them covered / double down because you're not really covered to the downside. But it's still an interesting thing to consider if you have your levels marked out in your mind of where you want to buy and sell your underlying, and hopefully you do with all the positions you have in your various retirement and investing accounts. All right, moving on to some other strategies that are very, very useful when you're talking about investing with options. Now, I touched earlier on this show, and indeed we did a whole episode about stock replacement, and that's a great thing to use when you're trying to save some capital and all the other benefits we've outlined about the benefits of using an in-the-money call versus a stock replacement. Now, that in-the-money call could be anywhere on the option chain. And typically, when you're looking at it as a stock replacement, you're looking a little bit farther out. We talked about 6 months, but you can even go farther out into the LEAPs, which are the long-term equity anticipation securities, usually a year or longer for the expiration on those. So those are talking much longer-term options. And that's for the typical, I hate to say buy and hold, but more of a buy and hold type guy who wants to put on a position. But you're not essentially just buy and hold because you're listening to a show like this and you know you can do more. And indeed you can using options. And we've touched before about stock replacement, but now how do you kick that up a notch? Again, to borrow that phrase. A lot of great ways to do that. And one of them is to look at essentially what is essentially a LEAP diagonal spread, a LEAP calendar spread. But before you get scared, before you freak out, it's not as complicated as it sounds. It really is just a covered call replacement, I guess you can call it. Because we're talking about now, you're taking your in-the-money covered call, which is longer term, 6 months, probably a year in this case because you're talking about LEAPs, so a year or longer. And now you're looking at generating some income. And if you were doing a covered call, what would you normally do? You'd focus on the nearer term of the options chain, so 1 month or perhaps even more frequently into the weeklies. And so now what you essentially have done is bought a very long-term LEAP call, and you've sold a very near-term monthly or weekly call against it. It sounds crazy, it sounds scary, but really you've just done essentially a covered call replacement strategy, and you've made your capital much more efficiently placed to do so as well. Now, Dan, I know you're a fan of this strategy and some of the other cool things you can do with LEAPs and diagonals. So, why don't you walk us through your take on this strategy and what else you like to employ LEAPs for with your clients?
Honestly, this is pretty much the only thing I encourage people to use LEAPs on. LEAPs they're kind of clunky old options, aren't they? I mean, they've got...
Yeah, I've never been a big fan. I wanted to set you up in case you had other things you were cooking, but yeah, this is pretty much my sole use case for LEAPs as well.
Yeah, I mean, they're big, fat, heavy, meaty, elephant-like options that have a year or two or more, up to 2.5 years, in fact, of time premium just sitting there decaying, albeit they decay slowly, but they decay. I mean, you buy a LEAPs call and you hold its expiration, unless the stock really takes off, you're almost certain to lose money. And if the stock really does take off, then you selected probably the worst way to trade it. So the only way to really make LEAPs work is to exploit that time decay nuance. Options that have a lot of time until expiration decay at a slow rate. Options that have a little time until expiration decay at a faster rate. So if I buy a LEAPs call and I sell a short-term call, I've got something good working for me. Now, Mark alluded to it being a covered call replacement strategy. That's how I love using these, the LEAPs diagonal. So what I would do is I would buy an in-the-money LEAPs call. And again, LEAPs being options that have a year to 2.5 years until expiration. They expire in January. I'd buy an in-the-money LEAPs call, and I'd sell an out-of-the-money 1 month or shorter time horizon call with the intent of having that short-term call expire, and then the next month selling another one, and then having that one expire, and then selling another one. So I hold on to that LEAPs with the little tiny theta, and I roll the short-term short calls with the big meaty theta, and now I've got something working for me. I've got time decay working for me. I do this only on a stock that I'm moderately bullish on, just like I would with the covered call. You know, if it stays exactly where it is, stays in a range, I win. If the stock rallies a little bit slowly, I win. Because it ends up with a positive delta, because the in-the-money leaps is going to have a delta above 50, and the out-of-the-money short-term call is going to have a negative delta below 50. So net-net, I have positive delta, I have positive theta, and I have limited risk when compared with the covered call.
Yeah, that's pretty much the best use case for leaps. You're right, they are a little bit of a, I guess, elephant options is a good word for them, kind of bloated, but they serve their purpose as long as you understand the shortcomings of those products and how you can use other options to get around them. Then they are indeed a useful tool for the situation we just outlined. Now, a couple other things to touch on about using options as investment tools. We talked earlier about things like how to use an in-the-money call when you're looking to replace stock, essentially as a stock replacement strategy. I mentioned there are other more sophisticated ways to do that as well. If you'd like to hear more about those, I recommend you check out episode 18 of Options Bootcamp, The Joys of Synthetics, where we get into things like combos. What a combo is essentially is buying a call, selling a put, or vice versa on the same strike. So if you're doing it on the at-the-money strike, you're buying a 50 delta call, selling a 50 delta put. Remember, that's a negative 50 delta, so that becomes positive. Remember your basic math, your basic algebra from back in high school. 50 plus 50 equals 100. Essentially, you have a position that is the equivalent of owning the stock, buying the stock outright with a fraction, a modicum of the capital outlay required. But of course, you have all the attendant pluses and minuses with that. It's going to move just like stock to the upside and the downside. So as long as you're okay with that, that might be an alternative way to create stock positions, longer term stock positions in your account using options. And another quick thing I want to mention, a lot of people, when we say using short puts as a way to get into a long equity position that you want to have for a while, you want to invest in, they may be worried, hey, what if it takes off to the upside? I'm going to miss that position. I'll never have established it. Of course, it's the same thing as working a limit buy order in the stock. If you're working a limit order and it never touches your limit, then you're not going to get the stock either. But be that as it may, one potential way to get around that using options and still being able to become a little bit more of establish a longer term bullish position is something called a risk reversal, which is instead of selling a call and buying a put on the same strike, you do it on different strikes. In this case, we're going to flip that around, make it a bullish risk reversal. So you're going to sell a put on a strike you don't mind buying the underlying on, and then maybe buy an out-of-the-money call as well on a strike you don't mind having a little bit of upside exposure to when, I think, just in case, in the worst case scenario, it's a little bit of a kicker in this case. In case the underlying takes off and you do miss it, you do have that upside exposure. Again, we're not huge fans of buying out-of-the-money calls. This is not a bad way to do it where you're essentially offsetting most, if not all, of your premium risk to do that. And it allows you to establish essentially a bullish position in the underlying with minimal, if not zero, outlay. So if you are one of those people who's worried about selling short puts and you're going to miss the upside, if you're that worried, you probably should just buy the stock or do some verticals, things like that. But if you don't want to do that, then this is another way to put on that type of position. All right, that's kind of going to do it. We've been going on for a while. I'll make sure to get a couple of your questions in at least here on the show. So again, this is kind of our overview of options as investment tools. If you want to break down more of any of these concepts in a lot more depth, I encourage you to check out all the episodes I mentioned here in our archives, episode 24, episode 25, and episode 20 being some of the key ones to really break down some of these strategies we discussed in a lot more depth. And you want more about the spreads and other things, of course, you can go find our basic and advanced spreads episodes and all that fun stuff. But now it's time to keep on rolling into our final segment, the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call. As I've said before, this is always my favorite part of the show because it gives you guys a chance to sound off and join us here on the Drill Instructor Squad. And our first question comes from Charles Binder, or maybe Binder, I don't know, and he writes, can you guys explain 60-40 tax treatment? What do I need to trade to qualify for this special consideration? Thanks for your help. Keep the shows coming. And John, as our resident margin/tax guy here on the show, pretty much because Dan and I can't stand that stuff, why don't you go ahead and walk our listeners through this very, very important question?
Sure. This is a tax law that is extremely beneficial to certain dealers and securities, options, commodities, market makers. And it's something called Section 1256, which means that for tax reasons, for tax purposes, the dealers or the market makers, 60% of the income derived from trading activities are taxed in long-term capital gains and 40% short-term capital gains. So you can imagine that is extremely favorable tax treatment. And this has been going on since 1981. And I think originally it was implemented as an enticement to get the dealers or the business professionals or the traders trading options and derivatives. And it's been a very favorable treatment for the market makers. And as far as Mr. Binder's question, you need to be a market maker, a trader, a broker dealer. I'm not sure what the qualifications are, but normal people can't get these tax treatments. And there's actually, I think the new administration now, there's been a big controversy or a big uproar that are trying to eliminate this current law, saying it's unfair. And there's maybe a point there. I mean, when I was trading, of course, I wanted to keep it, but now that the marketplace is so well entrenched and so well established, and everyone making markets and options basically is Citadel, Susquehanna, Wolverine, some big firms. What's the enticement now for the little guy to make markets? So, it's really, I remember back in the day, and Dan and Mark, I'm sure, had the same thing, where certain people that remain anonymous would, have a big year trading and make a lot, decent amount of money, and then a report would come called a mixed straddle report. And this is basically a 60-40. And we would look at it and then they'd give it to our accountants, and it would come back that the traders would only pay maybe 25-30% for taxes, including everything, because the federal rate was so low. So Mr. Binder can't get this treatment, and I think they may do away with it soon, but it was basically implemented to encourage market makers.
Yeah, and if you're curious if any of the contracts you trade really qualify for this, like John said, look up Section 1256 stuff, and that'll explain it in a little bit more detail. And I was joking earlier, but of course taxes are an important part of your options and investing strategy, and understanding how to maximize those is indeed important. We don't get into it too much here on this show, but it's something we think with tax time approaching might be a good topic for this show, the options tax consequences and indeed the changing options tax landscape. It's a crazy thing, as John just mentioned. They're looking at getting rid of 60-40. A lot of other things that are kind of old school options treatments are kind of going away. So it might be worth giving a refresher to the audience and indeed to all of us here on the show about exactly the current up-to-the-minute regulations when it comes to taxes on options. Now, unfortunately, that is all the time we have for the show. We went on a lot about the investment uses of options, but we like to do that here on this program as well. But don't worry, if you have a question you'd like to have featured on the mail call, I know a lot of you did, a lot of you wrote in, we'll get to them on a future show. But you can join your fellow listeners. A lot of great ways to do that. Questions at the Options Insider. Shoot us an email. We can put question for Options Bootcamp in the subject line, and we'll route it to the appropriate show. Of course, you can leave a comment on our website, theoptionsinsider.com. We'll route it to this show if it says Options Bootcamp or it seems appropriate for Options Bootcamp. Or, of course, you can find us twitter.com/options, facebook.com/theoptionsinsider. And we've even added a new volatility voicemail line for you guys to leave us a voicemail. We want to hear your lovely voices. And you have a question, 30 seconds to a minute you think is interesting, leave us a voicemail. Maybe we'll play it on the show. That number, 773-669-4VOL. That's 4865. And we'd be happy to listen to it and maybe play it here on the show. And, of course, that is all the time we have, but let me check in really quickly with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. That may interest you, starting with you, Mr. P. What is cooking in the land of Market Taker?
Well, Mark, we just had our one-on-one coaching application drive finish up. We accept applications for one-on-one coaching twice a year formally. Every once in a while, we can squeeze an extra one in here or there, but we had a good amount of interest, man. We basically filled up our schedules for one-on-one coaching for the next 6 months, and that's really all we have going on here. Nothing too exciting, nothing in the pipeline, just teaching the world options one person at a time.
Indeed, sir. Indeed. One at a time. Someone's got to do the heavy lifting. I'm glad you're there to do it. Well, I use more of a megaphone type approach. Each his own. All right. And Mr. Critchley, what is cooking in the land of SogoTrade.com?
We're on the verge of launching our new stock screener, and fair disclosure, I'm not a chartist, and I'm not really a big fan of screeners in general. But the screener that we had built, I think it's a pretty awesome screener. It takes a lot of noise out. It's an equity screener, but why I like it so much is we can use equity screeners, and I'll apply it to option trades. So that's coming out, I think, in the next few weeks, and it'll be, of course, a free trial and free if you have certain volume thresholds, and if not, it'd be some nominal fees. That's pretty exciting. And what else do we have? And then we have our elite platform coming out in the next month or two, and that should be great also. So we're looking forward to the year, and just began, and so far so good with the volume, and we're excited about 2014.
Indeed, it is an exciting year. We're seeing some interesting stuff. Maybe some vol creeping back into the market sooner than everyone anticipated, which is, of course, interesting for all of the options traders out there. And on behalf of Dan and John and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.